Understanding margin loans, the power of leverage. Especially in a high-yield dividend ETF, this strategy can become a catalyst for accelerating income and building wealth. In this post, we'll break down what a margin loan is, how it works, how it varies between brokerages, and how it can be used effectively with high-yield dividend ETFs to generate leveraged income. What is a margin loan? A margin loan is essentially borrowed money from your brokerage, secured by the value of the assets in your investment account. You can use this borrowed money to purchase additional securities, creating leverage in your portfolio. In simple terms, your broker is lending you money using your own investments as collateral. Here's a basic example. If you have $10,000 worth of securities in your account and your brokerage offers a 50% margin limit, you can borrow an additional $5,000 to invest, giving you a total purchasing power of $15,000. How margin loans work: collateral. The assets in your account act as security for the loan. Interest rate. You pay interest on the borrowed amount, which varies by brokerage and account size. Maintenance margin. Your portfolio must maintain a certain level of equity, usually 25% to 35%. If it drops below this level, a margin call is triggered. Margin call. You must either deposit more funds or sell assets to restore the required equity level, otherwise, the brokerage may liquidate your positions automatically. Brokerage differences that matter. Not all margin accounts are the same. Key differences between brokerages can significantly impact the effectiveness and safety of your margin strategy. Interest rates. Some brokerages offer rates as low as 5% for large accounts, while others may charge upwards of 10%. Interactive Brokers, for instance, is known for some of the lowest margin rates in the industry. Margin requirements. The maximum loan-to-value LTV ratio and maintenance margin vary. One broker may allow 70% margin on certain ETFs, while another may allow only 50%. Eligible securities. Not all assets qualify for margin loans. High volatility or low liquidity securities may not be marginable. Risk controls and alerts. Some brokers offer better tools for monitoring risk and alerting you to margin calls in advance. Using margin loans strategically with high-yield dividend ETFs. Now to the exciting part: leveraging margin for income generation. High-yield dividend ETFs like MSTY, QDTE, JEPC, and QQQI offer consistent and frequent cash flow. Here's how margin can enhance your income strategy. Amplified dividend income. If an ETF yields 10% annually, and you borrow at a 6% margin interest rate, your net yield on borrowed capital is still 4%. By reinvesting those dividends or letting them cover interest payments, your income engine gets stronger with time. Reinvestment power. Margin loans let you reinvest without waiting for new cash deposits. This speeds up the compounding process, especially when paired with monthly or quarterly dividend reinvestments. Income-covered interest payments. The key to smart leverage is ensuring that your dividend income at least covers your margin interest payments. This protects your capital from erosion and minimizes the need to sell assets to service the loan. Tax efficiency and timing. In some jurisdictions, margin interest is tax deductible if used for investment purposes. Also, dividends from ETFs held with borrowed funds may still qualify for preferential tax treatment, though this depends on local laws and should be verified with a tax advisor. Example strategy. Let's say you invest $100,000 in MSTY and QDTE with a 10% blended dividend yield. You borrow an additional $30,000 at 6% interest. Annual dividend income: $13,000 margin interest cost, $1,800 net income before taxes, $11,200 effective yield on total capital $100K, 11.2% effective yield on equity $70K equity, $30K borrowed, 16%. This kind of leverage, when managed wisely, can supercharge your portfolio's income and compounding potential. Risk management is crucial. While margin can enhance returns, it also magnifies losses. Here are some tips for staying safe. Use conservative LTV ratios, 50% or less. Only borrow against stable, income-producing ETFs. Keep a cash buffer or income reserve to cover interest. Monitor positions regularly to avoid margin calls. Stress test your portfolio for market downturns. Understand a margin loan is like buying a house. You can only rent it out, but not live in it, until you pay off the loan in full, while the broker collects all the rent money. This is for information only, not financial advice. For more info, click link in description.